Hello there, Maverick Traders. This is Rob Reinhold. This is another weekend edition of the Trading Room. We've got a ton of volatility going on in the market. Let's jump into it. In this session, we're going to be talking about the news. We've got a ton of news to go over. We're going to break down the markets, score everything from sectors to markets, from +3 to -3, and then we're going to go in and jump into those sectors and find some of the best trades in those sectors.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, a lot of things going on. Let's get into some of the news here. We got an intensified sell-off. Now, if you remember over the past 3 weeks, we've been pointing out that the Qs have been terrible. And that as long as you were looking at the right sectors and you were looking at the right areas, that the underlying market was just fine. And in fact, a lot of it was going higher. Guess what? That ended this week. We saw it on Monday, we saw it on Tuesday, but on Wednesday, everything flipped. And I was very, very disappointed to see the Russell go down well more than everything else. And the RSP went down just as hard as the Qs. So everything broke this week. Nothing held up except for the defensive sectors like healthcare, real estate, and utilities. Those were up, but everything else got hit. We had the FOMC meeting this week, and as expected, the FOMC held rates steady and hinted at a September rate cut. Then we had 2 nasty days on Thursday and on Friday, and now if you turn on CNBC, everyone's saying they should have cut rates on Wednesday. Look, the only reason they're saying that is because we've had 2 nasty days. If these last 2 days were up, everyone would have been patting the Fed on the back saying, well, you know what, there shouldn't be in a hurry to do anything. Look, there's going to be a rate cut, and in fact, the nasty day and the nasty economic data we had on Friday with the lower than expected jobs report has now made it to where the odds for a 50 basis cut in September rises. Now, I want to talk a little bit about interest rate cuts, and I want to tell you a story from 2001. So I was a young trader. I've been trading for about 3 years, and I'd only known a Federal Reserve to be hiking rates, so they hiked rates in, 97, 98, 99. And then when the bubble burst, they didn't cut rates for all of 2000, and everyone was like yelling at them to cut rates. And the market was just tumbling, just absolutely tumbling. And I remember thinking, and they said this on CNBC, that when the Fed comes in and cuts rates, that's going to put a floor into the market because now the market knows they're going to cut rates. The Fed, 2 days before a meeting, just think about this, 2 days before a meeting, cut rates by 50 basis points. And the market liked it. The market jumped up for 2 days, and then in the meeting, they cut another 50 basis points. So in the space of 48 hours, they cut a full percent, and I remember thinking, this is a no-brainer trade. I went in and went long. Even though the price action told me don't go long, the Fed just cut 1%. I got hammered on that trade, on those trades. I took losses, and I remember reeling and thinking, what happened? That was supposed to be a no-brainer. Everyone on CNBC said when the Fed cuts, that's good. Here's what I now learn and what I've learned over the years. If the Fed cuts because economic growth is softening, that's bad for stocks. If the Fed raises rates because economic growth is strengthening, that's good for stocks. Total paradigm shift, and I now understand that if the Fed would have cut rates on Wednesday, it would not have been taken negative. If the Fed cuts rates now, it's now going to be taken as negative because everyone is now saying that the Fed is now cutting rates because they're worried about the stock market crashing and the economy crashing. I don't think rate cuts at this point are going to help this market out all that much. We also got second quarter earnings. We had positive results from Apple, AMD, and Meta. really positive results, had negative results from Amazon, Microsoft, and Intel. So earnings have come out. Earnings have been overall good. This pretty much wraps up second quarter earnings. Earnings are in the rearview mirror. They were good. They were good. But remember, the stock market only cares about the future. And the future, people are worried about the future. And let me show you why they're worried about the future. We had things like the JOLTS job openings, they look pretty good. But then we got stuff like ADP employment, below expectations. This was the big one that really kind of started it all off, is on Thursday, we got ISM manufacturing coming in at 46.8. That's a low number. We've been hovering right around 50 for like the last 14 months. This is now accelerating to the downside, and the prices were up. And then we get this jobs report well below expectations, a jump in the unemployment rate to 4.3%. I now starting to hear all these stats flying around that, when the unemployment rate goes up 0.5%, which it has, it was down at like 3.5, now we're up at 4.3, that it's a sure sign of recession. Well, one of my favorite sayings, and my dad always used to say this to me, and I didn't really understand it when I was younger, but he said, economists has predicted 12 of the last 3 recessions. So whenever someone throws out these things, remember the inverted yield curve was supposed to be a guarantee of recession. Guess what? The yield curve's been inverted for like 2.5 years now, and the economy's doing great. So look, the reason why the market is freaking out is we are getting worse numbers. And remember, I showed you this little stupid video clip, and I talked about how when the market is in a good mood, it ignores bad news. And then when the market is in a bad mood, bad news becomes bad news. This is where we are right now. Bad news has become bad news. A couple of weeks ago, I said at some point, data deteriorates. At some point, the market's going to wake up one day, and instead of being happy that it's deteriorating, it's going to be really grumpy. That has happened. We have seen a sentiment shift, and let's go look at the charts, and you're going to see we have also seen a technical shift in the charts. So between a technical shift in the charts and a sentiment shift to where bad news is now bad news, I think you can tell where I'm going in my market outlook. If we take a look at the weekly returns, Dow, S&P down 2%, Q's only down 3%, had a monster rally on Wednesday. Look at that Russell. This is telling, especially when you take a look at the bond market. The bond market yields fell apart down to 3.8%. 3.8%. Now, any of you who are like needing to refinance or anything, you say, oh, that's great news. No. Just like the FOMC, when interest rates crash because people are scared, that's bad news. So lower bond yields from here are not good news for the stock market. Gold approaching new all-time highs. Again, this is a total risk-off move. Everything is spelling risk-off. Here is the chart in the S&P. Now, I was talking about how these were not good bounce candles. They were not good bounce candles at all. We had long upper shadows. And last week I said, hey, I think we have some more downside. We got a big green candle. If you take a look at the futures that trade 24 hours a day, we had a big engulfing candle here. And I actually made the video for our currency division after that big day. And I said, hey, I think that is a good tradable bottom. We cleared out of this range. We closed closer to the high than the low when you took a look at it on a one candle for overnight trading. And then it got absolutely slapped. This candle surprised me and told me, Rob, you are wrong. This market is not done going down. And you can see we dropped. The only lipstick I can put on this rally, not rally, but sell-off, is we do have a long lower shadow here. What does that mean? Well, it means we could have a bounce early next week. Here's the problem. Everything is now resistance. We have a ton of overhead resistance. We've got to get through this. We got to get through a 50-day moving average. We got to get through this resistance on the 20-day moving average. We've got a ton of overhead resistance, and we have a market that sentiment has changed. It's now more likely to go down than up. People are more likely to sell first than buy first. Here is the NASDAQ. Same thing. We got a little rally up to the 50-day moving average, hit our head on it, and got absolutely smashed. We broke down below the support. Okay, it wasn't a disaster of a candle on Friday, but that's about all I can say is it wasn't a disaster on Friday. I have no idea what's going to happen on Monday, but what I do know is that when we go into Friday pretty weak, we typically get a gap down on Monday. But remember, if you've heard me over the last couple of years, I say markets rarely bottom on a Friday. They usually bottom on Mondays and Tuesdays. If there is going to be a bounce, it's probably going to be on Monday or Tuesday. If there's no bounce on Monday or Tuesday, then we need to talk about even more downside here. Even if there's a bounce, we have overhead resistance. So much overhead resistance that I think you have to be very pessimistic of any of the rallies having any legs of any kind. If we go here and take a look at the heat map, it was an absolute disaster in the large cap. If you take a look at tech, semiconductors, just a wipeout, software, total wipeout, some consumer, total wipeout, financials had a big turnaround. Okay, if you take all those out, you can see the rest of the market is not so bad. Energy got crushed, but take a look, everything else isn't terrible. It doesn't mean it's good, it just means it's not terrible. We have now shifted to a bearish bias. We have to expect rallies to fade, especially in those tech stocks. I think the Qs are definitely on their back foot. Regular stocks are probably still going to outperform, but like I said, this week it got everyone. Everything this week except for the defensive sectors really went lower here. At this point, bad news is bad news. We have to take a look at this, and when we see economic data, bad news is bad news. We are now in a market regime where it says the economy matters. Before, if the economy was weakening, everyone clapped and said, yay, we're going to get rate cuts. That is not the case anymore. And if you take a look at bond yields, lower bond yields is negative stocks. The best thing that could happen to bond yields, in my opinion, is we bounce up to 4% and we don't go any higher than that. We just hang around that 4%. I think the market would like that quite a bit. Last week we had a ton of news. This week we've got nothing. And really the only thing that I think is going to matter whatsoever is services ISM. Over the past 14 months, manufacturing ISM has been weak. It's been below 50. Last month, we got a shock of the ISM. Services number was now below 50. That was a shock, and the market actually did go down on this before it recovered. We're supposed to come in at 51.4. If this number can come in above 50 or 51, I think the market is going to have a sigh of relief and probably have a little rally off that. Now take a look at the time. This comes out at 10 Eastern. So that means we've got 30 minutes on Monday morning that's probably going to be fairly nasty. We'll have to see where the market opens up, but I would not be surprised if we had a gap down on Monday morning. And then if this news comes out and it's a decent number, I do expect we will get a bounce off of this number. If this number is below 50 again, this market is probably looking for a bounce later in the week if it bounces whatsoever. As you can see, nothing else on the calendar. So the score, technically speaking, is a -2. Remember, we've been talking a lot about the Qs. We've talked a lot about this RSP ETF, this equal weighted ETF. The reason why we talked about this is that the Magnificent Seven stocks, the large cap tech, have become such a big part of the overall index. When they are great, it can mask a lot of underlying weakness, and just on the opposite, when they're very weak, it can kind of mask a lot of strength in the market. So sectors are the key to this market. If you look at the sectors and you play sectors and you kind of ignore the overall market, you've been doing just fine.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6 and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
Last week we had 2 sectors at +3. They were real estate and financial. And you can see real estate did just fine this week, up 3%. Financials, you're going to see that they got a big downgrade this week. Comm services actually had a decent week. Most of that is because of Meta is such a huge company. My guess is if we took Meta out, it was down 1% or 2%. Utilities, real estate, healthcare. Okay, this is defense. This is what people buy when the markets go down. So yes, these have been stronger over the last couple weeks, but this is definitely showing that this is a cyclical worry in the stock market. People are now worried about growth. When people are worried about growth, they buy these and they sell industrials, financials, consumer, and tech. This is if you were to open up a textbook in economics, this would be the play. Hey, when people are worried about growth and the economy is in recession, industrials, financials, consumer tech, these are all cyclical. They're going down, along with energy. This is just a perfect textbook play. What goes up? Things that are defensive, especially when interest rates are coming down. Things that are defensive with a dividend yield that's now going to be more attractive because other fixed income investments are now looking less attractive. This is classic. This is classic cyclical movement when people are worried about economic growth. This is likely to continue until people are no longer worried about economic growth. Utilities were a +1 last week. So look, they were already acting well. We're going to bump that up to a +3. Communication services, as you can see, had the big run off of the good Meta news, but turned right back over. It was a -2. We're going to go to a -1 because, again, the whole market has pulled it up, or at least Meta has pulled this whole sector up, but we're still not bullish on communication services. Real estate was a +3 last week, +3 this week, did absolutely great. Healthcare was a +2 last week. It's going to get bumped up to a +3 this week. So the things that were already doing well have continued to do well. If you've been playing sectors, you've been doing okay. Industrials, this was one that had a major turn. So there's 2 sectors that were looking positive that now no longer look positive, and this is one of them. So we reversed here off the top. We are now trading below the 20. We're trading at the 50. We're at a -1 on industrials, and financials were the other. Financials for the first couple days of the week, we're looking great. Even though the rest of the market was a little shaky, they look great. Thursday and Friday were just an absolute disaster, all the way down to a 0 on financials. So the 2 sectors I really want to point out, industrials and financials that looked like they were still holding up, totally rolled over. Discretionary had already been moved down from a +3 to a +1 to a 0. Now we're at a -2 on consumer. So it was already getting downgraded for the last couple of weeks. Technology was at a -2. It's in a -2 still. Once these make a little death cross here, then we can go to a -3. But again, technology has been the weakest. Materials, another sector that looked really good the first couple of days of the week. It got hit. Still showing some outperformance, but we have to look at it as a 0. Energy did not hold up like materials did, and you can see energy is heading much, much lower. -1 really could be a -2, but we're just right at pretty major support levels here. So look, -1, -2, you do not want to be long in the energy sector. This is where we were last week with healthcare, real estate, financials, and industrials looking good. Comm services, we're going to bump that up by 1, but we are not bullish whatsoever. On the downgrades, these are things that really fell. Consumer, industrials, financials are now neutral to bearish. We had move up in utilities and healthcare, and a little bit of a move down in materials and energy. Here we are. This is cyclical. This is simply cyclical worry of economic growth. What's likely to stay weak? Consumer, tech, industrials, financials, comm services, energy. Materials is at a 0, but look, I'm not crazy about it whatsoever. As you can see, there is more weakness, more reasons to be short than long in this market. If we take a look at where we were last week, remember, we had come to where we were pretty much neutral. We had pretty much as many bulls on as bears, and we were really in the middle. And we had some trades that did pretty well that rolled off. So in the utility sector, our PCG trade was slightly positive. Our PARA trade was slightly a positive in comm services. So just slight winners on those. Our trade on UNH healthcare was a winner, max gain. Financial was our Robinhood, which was a max loss. So as you can see, it was a so-so week, slightly positive, slightly negative on the ones that expired. But here's what I just love, and I'm really proud of our traders, is that when the markets turned back in July, we had a week or two there where there were pretty good losses, to where a lot of the traders were leaning bullish, and during those weeks, the bullish trades took losses while they were putting on new sideways and bearish trades. Now this week, accounts went up. That was great to see. Accounts either were flat or up. It's great to see our traders shift to mirror what the rest of the market was doing, because that is the key to trading now on a top-down approach. You got to move your portfolio to match the underlying conditions. We are at a -2. So if we take a look at what are our trade slots available in a -2, here they are. We're only allowed 1 + 2, and then you can see 2, 3, 4, 4, 1. Our current allocation are the ones in the black. So we do still have OTIS, and industrials. That does not look good. That looks like that is definitely going to be a max loss. We're going to be adding 2 + 1 trades in utilities in real estate. So we're not even going crazy bullish. We're actually going +1s in defensive sectors. If I was super bearish here for the week, I would be like, hey, let's put on some bears. Here's the thing. I think we are likely due for a little bounce. I would like to enter off of bounces. I would like to enter more shorts off of bounces. So this week, I'm looking really just to really fill in the middle here. And this is going to put us to where we're basically balanced again. We're not leaning too far to one side. I'm very happy to be only in 10 trades. Remember, we can be up to 15 trades. I'm very happy to have a bunch of cash sitting there and just having very, very narrow trades. You can see 8 of the 10 trades are all theta positive trades, meaning they're going to make money on sideways price action. We only have 2 trades that are really leaning one way or the other. So as you can see, we are definitely in a defensive lean in this portfolio. Let's take a look at those 4 possible slots we have open and some possible trades to fill them. In the utility sector, Next Era Energy, NEE. This is a +1, and this is where people who are stock traders, when they come to become options traders, every stock trade they make is one they think is going to go up the most. And so they end up, really only looking for very aggressive trades, because in the world of stock trading, that's what you want. You want a trade that has the most upside with the least amount of risk. In the world of options, you're just trying to find a stock that fits your option strategy. We said we're going to do a +1. We already have picked the strategy. It's a 0.6 delta bull call spread. We've already picked that. We don't need it to go up. And in fact, if it goes up a lot, we make nothing extra on it. It's silly to even think that we want this thing to run up to, $90 a share. We just want this trade to basically be above 80. That's it. Just be above 80 by the time this option expires, and it's going to be perfectly fine. So let's take a look at the trade. The August 16th, 77.50.80. Bull call spread. So they're right here. The stock is at 79.20. If it goes sideways, guess what? We're profitable. If it goes up above 80, we got max gain. And of course, if it goes lower, we've got $1.50 risk for $1 of gain. We have a 60% win-loss built into this trade, statistically speaking, with options. We're not being crazy here on any bullish trades. This market is not the right place now to add on aggressive bulls. In real estate, also looking for a +1, so the same thing. I don't need a stock that's going to run higher. I don't need this well tower to run up to $125. I just need this thing to not go down. Right now is at $112.76, so we're looking at the 110, 115. This is closer to 50-50 right at the middle, so this is going to have a 1-to-1 risk-reward ratio, 50-50. Okay, if it goes up a little bit, we make a little bit. Goes down a little bit, we lose a little bit. If it does close above 115, that's max gain. If it closes below 110, that's max loss. Pretty straightforward trade. Again, I am not looking to make any trade that has any sort of need to go higher or lower substantially. In the healthcare sector, we were looking to fill this with a 0. So I went out there and I said, okay, what is a trade, a stock that I think is going to be basically flat for the next week, week and a half? And I came across this Abbott Labs. And I do like this one because we just broke some pretty good resistance here. So had a good bunch of resistance here. And you can see we've now cleared out of this range. So this 108 should become some good support. And you can see on Friday, we actually came down and got close to this 108 before the buyers came back. The candle on Friday was an up candle on a really nasty down day. So it does have a lot of momentum to the upside. People are buying this as a defensive stock. Okay, so why aren't we just flat out long this? Well, it's got some pretty brutal overhead resistance. And on this chart, you can't go all the way back, but you're going to see there's a lot of resistance in the 114, 115 area. So this is what I'm looking for in a butterfly. It has now cleared out of resistance at 108, which should be really good support. And I think it's got really nasty resistance up ahead. Hey, this sets up for a really nice play on a butterfly. So you can take a look at short term. If it's short term, like this week, I think you want to be more bullish than bearish because look, this thing does have some good momentum at the moment. So I think you want to be up at the 112, 113 area for the middle of your butterflies. If you're looking to go 2 weeks out, which I am, I'm just going to be flat right in the middle. The stock's at 111 right now. I'm going to be at 111, and I'm going to do the 107, 111, 114. That's going to be the range here. If it hangs out in this area, I'm going to be very, very happy at the end of this trade with a nice profit on a butterfly. And then the last trade, and look, sorry, these are boring trades. There are old traders and there are bull traders, but there's no such thing as old, bold traders. In this kind of market has the potential to kill people. There are people that this week were wiped out. There are people that on Friday, they closed their account down because they were wiped out. Why? Because they were leaning too far. And volatility spiked. And because volatility spiked and they were leaning too far in one direction, they were hit. And look, people right now went into the weekend heavily short. If we bounce back next week, they'll get knocked out. This is where capital preservation matters. Keeping your capital. So as you can see, these trades I'm making, they are not even set up to make any sort of real money. They're also not set up to lose any sort of real money. These are going to be, hey, let's go for some singles. while we wait for this market to figure out what it's going to do, where it's going to go, let's throw some money out there, let's try to get some singles and get a little bit of growth. But for the most part, we're hunched over. We're keeping our capital dry for when there's a better opportunity. This is Toronto Dominion Bank, and kind of the same story where we have some really clear support and resistance on this trade. It's right now trading at $56.69. So here is the issue on this trade. I won't even call it an issue, but here's a decision to make. We have strikes at 57.50 and 55. So these are the two strikes that you have to pick. You have to basically pick, are you going to lean more bullish and do a 55, 57, 50, 60 to where it needs to bounce up a little bit? Or are you going to do the 52, 50, 55, 57, 50, where it's bearish, where you say, hey, I think it's going to come down into that area? That is the decision that needs to be made on this one. This one is between strike prices. If you want to do the bearish one, go down to the 52, 50, 55, 57, 50. This is one I'm looking to do. I'm going 2 weeks out, so I am assuming there is going to be a bounce somewhere in this area for the next week or two, going out to the 57.50 to where I'm leaning a little bit more bullish. So here's the range here, so I want to be closer to in the middle of that range. Slightly bullish on this one. That is Toronto Dominion. I only have 4 trades for you. 2 zeros, 2 plus ones. That's a boring week. Remember, it's very important to preserve capital in times of volatility. At some point, there will be a clearer signal, whether that's long or short. It'll be a better signal. Let's just wait till then. Make some trades, make some sideways, make some plus ones. We call them chicken trades. Let's just wait until the market is showing us a little bit better action. The market tide has turned. The sentiment has turned. At this point, I think you need to expect rallies to fade. But I think you need to expect rallies are going to happen. That's what happens with high volatility. You get massive rallies kind of out of nowhere. Those are the ones you kind of want to wait for. And that's a great time to enter bearish trades. Sector analysis is the key to this market. If you've been using sector analysis, you've been just fine. If you haven't, if you've just been trading your favorite names that you always just end up trading, you don't know what's happening. You've got this huge tsunami washing up against your positions, and you don't know what's happening. You don't understand that every single tech stock is going down, not just yours because you, quote, picked the wrong one. You could have picked any tech stock, and you're getting hammered for the most part. It's not about the stocks. It's about the sectors and the market. That's why we do top-down approach at Maverick. That's why we do our slots. That's why we pick our options trade first to match that. That's going to keep us much safer. Everyone have a great week, and we will be in touch with you this next week with our market roundups. Goodbye, everyone.